Welcome to another exciting edition of the Trading Bell. Today on the program we have a special guest, and this is the Absa Kenya Managing Director, Jeremy Awori, a man who continues to blaze the trail in the banking sector and has some interesting developments when it comes to the digital revolution happening in Kenya's fintech space. He'll be talking to us about their recent results as well as the future of the bank. And are we out of the pandemic yet? What do the executives have to say about this? We'll be picking his mind on this and much more. We start off with a quick look at his profile.
Jeremy Awori is the Managing Director and Chief Executive Officer of Absa Bank Kenya PLC, part of Absa Group Limited, a position he assumed in February 2013. Prior to joining this organization, he held various positions within Standard Chartered Bank, among them CEO of Standard Chartered Tanzania from 2008 to 2012, Regional Sales and Performance Director at SCB Middle East, South Asia and Africa from 2005 to 2008, and Head of Consumer Banking in SCB UAE from 2003 to 2005. He also served in Standard Chartered as the Executive Director and Head of Consumer Banking for East Africa. In addition, Jeremy has lived and worked in the UK, North America, and Asia. He completed his master's degree in Business Administration from McGill University, Montreal, Canada, and holds a Bachelor of Science degree in Pharmacy from Manchester University in the United Kingdom.
Welcome to the show, Jeremy.
Nice to see you. Thanks, Abby.
Last I saw you out in the golf course with the president.
With the Magical Kenya Open.
It was a great event, I believe so.
Yeah, it was really exciting because we've had 2 years where we've been in lockdown. So I think everybody wanted to come, wanted to support, and I think we thoroughly enjoyed ourselves. And we had top class golf, and then we also saw Njoroge coming through as the amateur leading the way for us.
Right.
So it's nice to have. To see a Kenyan doing well and to see us back to getting people together again.
Amazing. I was part of it and it was totally one of the best events ever.
Great.
Let's talk numbers now. And speaking about getting people together, you recently released your full year results and some impressive numbers. Looking at the numbers, you struck a growth of about 175%. Many are asking, how did the bank achieve this with so much headwinds from COVID, from slowdown in spending? What triggered this for the bank?
Yeah, I think this has been a journey. I don't think it's been something which just happened in 1 year. We've been at this for the last 5 years. We had a strategic agenda. We invested significantly in our business. And what makes this probably even more special to us is we were doing the transition from Barclays to Absa, which came with its own complexities, right? And really kept us busy for 3 years. But I think fundamentally there'll be a few things that drove our performance. I think is focus on the customer and really trying to understand what the customer wants, and where we were falling short, we invested in terms of functionality and products and services. That's number one. I think the second thing is around innovation and automation. We've spent a lot of money. In the last 3 years, we have spent 5 billion shillings on upgrading our platforms, bringing in new platforms, new systems, because and we're glad we did, because we weren't anticipating COVID.
Sure.
If we had COVID 3 or 4 years ago with the platforms we had then, it would have been quite a different situation because we didn't have the platforms and the functionality. So I think innovation and automation was important. The digitization part as well, doing everything on mobile apps or on websites, made things easy and convenient for customers.
Sure.
And then I think we had strict COVID protocols. So we never closed the branch throughout COVID. Yeah, even though we had cases of COVID, we had a very good resilience plan and backup plan so customers weren't affected. I think the other things that have sort of come through are we've diversified out our business substantially from 2013. We've introduced many new businesses. We didn't have a bank assurance business.
Correct.
We didn't have a fixed income brokerage business. We didn't have a risk management solutions business in markets. We didn't have an asset management business. We didn't have a brokerage business, right? So these are all new businesses that get us into new revenue streams, and we're very encouraged that those new revenue streams are growing and building on the strength of our core businesses, which is retail, business bank, and corporate and investment banking. And we see more room for growth in those businesses, and we still want to get into more businesses, which I think is exciting.
All right. And Jeremy, you are one of the banks that really stood out during the height of the pandemic when it came to just cushioning some of your customers as well as cushioning entrepreneurs who run the enterprise side of business. Talk to us about the experience during that window of time, and are we seeing a reduction in the non-performing loans now that the COVID is easing off by the day?
Yeah, I mean, when COVID hit, I think all the banks and all businesses were now kind of thrown into disarray. What do we do? Some businesses in hospitality were just shut down, right? Those had bank loans. They were worrying, what do they do with the employees?
Yeah.
And we sat as a leadership team, and I really pushed the thing of, we don't want to be fair weather friends. When things get bad, we withdraw the umbrella, right?
Yeah.
So we said, look, let's do things differently. We'll show the true character of Absa, and we were the first bank to introduce moratoriums and restructures. So we were saying, look, use your cash flows instead of having to pay us now when you're struggling. Use those cash flows to either remain open, or to pay your employees, or just whatever you need to do to remain open
to sustain the business.
To sustain the business.
Yeah.
We'll worry later once we
Correct.
get out of COVID. We didn't realize how long it was going to be at that time, to be honest. So we restructured over 60,000 customers' facilities, over 60 billion, which was a third of our lending book. And we're excited that now over 95% of those are back on track, and the remaining 5 we're still working with, to make sure we didn't want them to go bankrupt, because these are Kenyan businesses run by Kenyans, employing Kenyans, and the last thing you want is people losing jobs in an already difficult time
environment.
So that's what we felt pretty pleased. We believe we should be a force for good. It's not just about profit. It's about also making a contribution to the community.
All right. And of course, this feeds into the theme around Africanacity.
Yeah.
And I'd like to get your perspectives on the sector in terms of the non-performing loans. The central bank had raised the red flag, saying that we need to cautiously walk down that path. I don't know, how has the experience been for the bank, and what are you seeing in your rear mirror?
Yeah, I think we've been, we're pretty conservative when it comes to non-performing loans. And we believe if we start seeing early signs of difficulties, better we have a conversation with our customers. Yeah. Because then they may not necessarily see it. And we've seen it time and time and again for different businesses. And then normally we try and work with them around what they can do to manage themselves out of this crisis. So it's an early alert kind of system. So that gives us a lot of positive movement and keeps the customers who are struggling out of getting into an ICU situation. So we've been quite good at that. We're quite strict on our criteria in certain instances. And I think as a result, if I think back, we're probably one of the few banks where we made conscious choices around what facilities we gave to certain clients. And you can think through the big names without me mentioning them that are in the public space with serious unpaid debts. As I say, I won't mention them, and there's several across different businesses. And we're fortunate, we don't have any exposure there. But what we did do during COVID is we did take sort of forecasts around what we thought were macroeconomic overlays or variables. So we'd say, given this outlook, how many customers are likely to get into default? And then what we did is we provided for that sort of prudently. So that did push up our impairment, because we wanted to be sure that we had sufficient capital, because when you're in this situation, you need to make sure you had capital. So that's put us in there. And our net NPLs are actually much lower than the industry at about 7.4%, 7.6%, compared to the industry average at 13.1%.
All right.
Yeah.
And as you sip some water, my next question is touching on, as a bank, as an executive, one of the key deliverables is shareholder value. And I see right now there's the pressure from banks to declare dividends, not only banks, but also SACCOs. And are you feeling the pressure yourself?
Yes, for sure. Shareholders, they're not. They're in it for business, right? They're not. They don't want a lot of excuses. They pay management to deliver results for them. So we are not. We're not absolved of that responsibility. What I think our duty is as the leaders and the board in the bank is to make sure our business can last in the long run, right? And that we have sufficient capital, sufficient reserves to see us through the cycles. And I think with a bank, if the banking sector is not healthy, it's very difficult for the economy to be healthy.
Sure.
So for us, the pressure is definitely there. We've taken very specific decisions around our investment agenda, and I've mentioned about the projects we've invested in. This year we're going to be investing another 2 billion, in 75 new projects. So even through that whole COVID cycle, we were investing. Last year we invested 1.6 billion. Yeah, and still we're in a position whereby we were still giving okay results. We made the decision this year that things were starting to resume back to normal, that our shareholders needed their dividends, and that's why we brought it back to the 2019 number, and we're paying out 6 billion to our shareholders.
Interesting numbers there. And looking at where the bank is at the moment, we're seeing a lot of digital disruption that is permeating into the financial system. And Central Bank Governor Dr. Njoroge is on record saying that banks must really up their game when it comes to payment solutions and just playing a more proactive role as an intermediary in the financial sector. And from where you sit, where is the future of banking headed towards?
Yeah, I think the governor is quite right? Any industry, banking is not exempt from that. If it doesn't evolve with customer needs, you're going to find new people coming in. And I think the fintechs, the tech fins are coming in and coming with solutions. And you've mentioned some areas around payments. Yeah, we've seen the big players coming in. We've seen the telcos also coming in and muscling in on bank customers with simplified processes. So for us, what do we focus in on is, again, it comes back to the customer, understanding the customer's needs, coming up with products and solutions that work for them, where they need them and when they need them. And I personally believe that it's going to be largely digital for your vanilla transactions, moving money from A to B. That digital hopefully will allow the price of those transactions to come down, because over time some of these costs are still too high. But it's the nature of the environment. So if we work as an industry to bring those costs down, then we should pass it to the customer, and we can still retain our profit to the shareholders. We shouldn't hold it. I think it would be great to see some of these tariffs coming down. So I think that's definitely an area that that we're looking at. And then it's also coming up with value propositions that they can't. Now the tricky part is some of the institutions that are coming in are not always regulated the same way as banks. They don't have minimum capital requirements, and I think the central bank is working on that just to make sure we have order in the market.
Sure.
Yeah, and we don't also have a system where customers are not treated fairly, which is very important, right? A customer should understand the product they're buying, the terms upon which they're buying, and that they're treated fairly through that process.
All right. And what percentage of digital banking do you feel the bank will be headed towards? Because this device, Jeremy, both you and I know, this is where the battle is at. It's no longer about the brick and mortar. Yeah. Walking into your branch today, I saw a fairly low head count, which is very telling of the times we live in.
Yeah. No, absolutely. I mean, I think, we're going to see this, upwards of 95, 96, 97% of these transactions being done on mobile. And why is that? That's just because it's convenient. Think about the days when you had to pay salaries. You'd have to go and draw the cash and then you'd have to pay.
Sure.
Now you can do it from your bank account straight to an e-wallet or to their bank account, with the touch of a button. So we see that evolving. What we do, however, we see a situation whereby the things which can't easily be done digitally will continue to be done face to face, like the advisory part. Like if you're thinking about buying a home, you want to have a proper conversation. If you're investing if you're investing for your child's education, when your child is young and they're talking about those wealth management products, you probably need a conversation. But for the sophisticated investors, they will also they know what they're buying. Once we have cleared that they are that they understand the products. Even they'll be buying things like unit trusts online.
Yeah.
They'll be getting mortgages. I see data analytics being a huge differentiator. We'll start using data as the new security. Yeah. So instead of saying I want your logbook or I want your title deed, the data that is out there in the ether is in a position where it can tell us about you. It can tell us about your behavior patterns. It can tell us whether you're actually good for paying back your loan. So we're also investing heavily in that space as well.
I did see in your books that your cost-to-income ratio is at about 45%.
Yeah.
And back to what you're saying, as we go digital, it's not cheap to go digital. There's a heavy investment outlay that the bank puts in. And what is the return, not only for the bank, but also for the industry?
Yeah, it's definitely a very heavy outlay, because with many of the big banks in particular having hundreds of thousands or millions of customers, if those systems go down, then customers get very annoyed. So you've got to have your systems up, number one. Almost you've got to be at 99.9%, right? Because we otherwise they'll get frustrated if they don't believe that they can get the service. So the investments are essential. I think now they're almost the ticket for the game, right? There's nothing, if you don't have the basic things on your digital platform, I don't think customers will consider you. And in particular with young people. Young people have never banked in an era. We maybe have banked in an era of going to a branch.
Yeah.
Young people ask me, like my kids, they ask me, why would I go to the bank, Dad? And I really don't have that much to say. So I think for us, it is hard if you don't get embedment and you don't get usage, and that's what we're focusing in on.
All right. And as we shift gears, we've seen a drastic shift in the cost of credit, and this is becoming the talk of town, because at the end of the day, we removed the cap on interest rates. We are still seeing interest rates oscillating at just about 13%. And there's been push and pull around risk-based pricing. I'd like to hear your thoughts on this, and what impact will this have, especially in lowering the cost of credit?
I think people need to probably recognize that there's two things. Risk-based pricing in and of itself doesn't necessarily lower the cost of credit for everybody. What it basically says is that we look at each customer or each group of customers who have similar features, and we assess their risk and their likelihood of default, probability of default, etc. And based on that, we can then price them accordingly. So a higher risk customer will get priced higher, a lower risk reliable customer should get priced lower. Yeah. So that requires data, like I've said. So we've been in back and forth with the central bank discussing about implementing our risk-based pricing, and we've given them our data, which shows, we would like to have a range above 13. I think personally that it shouldn't really cross probably 20% if you use today's macroeconomic situation and interest rates. And then what that will do is that will allow a sector of people who are not able to borrow from banks to get into the formal borrowing. Yeah. Now the advantage of that, today those people are being locked out of financial system. So they're going, if you ask me, to Shylocks and different types of lenders who don't look after their interests, right? So we're encouraged. Hopefully we can get our approvals in due course, and we think it will be good because it will mean faster private sector credit growth, and that's good for the economy. And what it does, it in terms of price, even if it becomes 15% or 16%, it allows the bank to actually still make a return. Hence, it does the lending at that price.
Allow me to put you on the spot, Jeremy. What's the lowest we can go?
In terms of rates?
Yeah.
I think the lowest we can go is literally strictly determined by two things. One is the macroeconomic situation, because the alternatives banks have is the risk-free rate. So the risk-free rate is your T-bill rate and your treasury bond rate, right? So technically banks have the option that they could go and say, I don't need a collections team, let me go and invest in a government security, and then I just get my return and I slim down my team. So that's one variable. So that's why we want to see a system where interest rates are low in the country, right? It's also good for government because they don't pay any more than they need to from that perspective. I think the other thing is if businesses get better at sharing more information with us, and putting more information like their revenues and their sales through the system, we can make better decisions and we can then give them probably better rates. A lot of this is still very informal, it's cash-based.
Yeah.
So somebody tells you, I'd like to borrow, you say, just show us what you do, and they can't, right? And they may be quite big businesses, whether it's Mitumba or small traders. So I think we need to get both. We need to work with businesses to get them to understand the value of this, and at the same time try and drive generally a lower interest rate environment, which is a bit tough right now, just given geopolitical events, things like food inflation because of weather. Those affect things like the interest rates and the exchange rate.
All right. And we can't finish this conversation without talking about the upcoming elections and the foreseeable impact this might have on the economic sectors. And from your vantage point, what do you see in your crystal ball? Are we likely to see a sort of stabilization of the economy, or it's still a mixed bag of fortunes?
Yeah, I mean, this is $1 million question, right? The way we look at it is there's a short-term reality, and then there's a longer-term reality. If I start with the longer-term reality, we've had multiple elections. We're still here today.
Sure.
Right? So even with this election coming, we'll be here in 2023, 2025, and I think Kenyans are resilient. We want to get about our business and try and improve our livelihoods and our lives, right, and look after our families. So I think in the long term, I know this is a transition, from His Excellency President Uhuru Kenyatta. The thing that in the short run that it does is there's always a level of uncertainty, and based on some of the past events, people are just not sure. So it could manifest itself in businesses saying, I'll wait until after the elections before I invest and build a factory, or before I update my manufacturing line, or before I hire more people, because if my business is disrupted, that could be there. But we're seeing good GDP growth coming out of the last 2 quarters. I think the thing that's in our favor, honestly, this is just my personal opinion, people are tired of COVID and the difficulties COVID brought, right?
Yeah.
So we just need to be positive, right?
Yeah.
So I think, yes, there's elections going on, but people are like, I have my day-to-day living too.
Sure.
And I think that's going to lift us up. And I just plead with the politicians, let's just keep it in a way that we don't scare off investors, and that we keep it peaceful, and run in a way that people build confidence in Kenya. Kenya is in a unique place, where a unique hub in East Africa. People want to invest here. Foreign direct investment for Kenya, we could be having much more than we're having today. And I think between business, private sector, and public sector, once we go through this, that's what we need to focus in on, because that will lift the livelihoods of Kenyans.
All right. And in closing, Jeremy, there are a couple of measures that were instituted in regards to the presidential directive, where transactions above $1 million, there are some easing that happened. I don't know, how has this been transmitted to banks, and are you seeing a good uptake around it?
Yeah, I mean, I think the thing we need to keep in front of us is that some of these levels, whether it's $1 million or $10,000, are driven internationally, by anti-money laundering standards, know your customer standards, So if we go against global standards, that puts us at risk of being moved from the blacklist to the grey list, and that has consequences on things like the rating of the country. As we've seen, some countries being moved onto the grey list, like Mauritius was moved onto the grey list because they didn't do certain things. So I think what's happening between the regulator, businesses, is we say, let's make sure that we don't try and veer off too much on this side. And customers, look, just try and declare, right? And that might not be easy for everyone, especially now.
The season we are in.
The season we're in, but there's a bigger game to play if we go down that route.
Amazing. Many thanks for your valid time, sir.
Thank you so much. Good to see you.
Great to see you, sir. Well, we've been speaking there to the Managing Director of Absa Kenya, Mr. Jeremy, just giving us the outlook for the sector, and he's quite optimistic that the country will be transitioning through the elections, and He's also optimistic that the future of banking is truly digital. Well, that's all the time we had for you on today's show. Many thanks for your valued company. Until next time, bye-bye from us.